Good, how are you?
Good.
Let me ask you, what's the difference between the chicken nuggets and the chicken strips?
So the strips are long, lengthy, like strips that you find normally. Nuggets are just nuggets fried.
Alright, so the chicken nuggets and the chicken strips, they're not the same.
No, they're not. The nuggets are small.
Alright, which one's performing better right now? The nuggets?
Yeah.
Well, then I will have the nuggets.
All right.
Hi everyone, Keith Wilson here, helping you to be wise with your money. Now, as a financial consultant, over the years, I've heard these remarks, one of which is people would say, wow, the economy is really, really bad. I'm probably going to lose money in the stock market. Or, on the flip side, they'll say, man, the stock market is crashing. Am I going to lose my job? Well, what you've got to realize is the stock market is not the economy, and the economy is not the stock market. So what you got to understand is the stock market. The stock market is an exchange where investors are buying and selling shares of companies. So, therefore, the stock market is comprised of buyers and sellers and is not necessarily indicative of every business, worker, and family. Whereas the economy, well, that's different from the stock market. So the economy is more of the production and consumption of goods and services, and that's measured by the GDP, or gross domestic product. Now, that GDP, that can be increasing or it can be decreasing. Listen, it's understandable when there's some negative economic data out there, like rising unemployment or negative growth in the GDP. People get worried about how their investments may be affected. But the economy and the stock market, they rarely move in tandem. They don't always travel at the same time, at the same speed. A lot of times the market can go up and up and up while the economy is bad and it's going backward, or vice versa, where the economy is fine, yet the stock market is tanking. For example, let's just look at the fourth quarter of 2018. During that time period, according to Yahoo Finance, the S&P 500 dropped 15.3%, while at the same time, the GDP, which is economic growth, that was up 2.2%, and unemployment rate was at a very low rate of 3.9%. But on the other hand, if we look at something here quite recently in 2020, from March 23rd to August 1st, now this is according to Yahoo Finance, the S&P 500 increased over 41%, and at the same time, we saw the second quarter growth, well, that shrank over 32%, and that was the worst in history. And unemployment rate soared to over 11%. So you're probably asking yourself, how in the world can this happen when stock market just continues to go up and the economy is really, really bad, or vice versa? The economy is really good and the stock market tanks. So you see, the stock market is forward-looking, meaning they're basing their share prices on expectations of future earnings, on company profits and growth. So it doesn't matter whether the news is good or bad. What matters is whether that news is better or worse than expected, because the stock market has a tendency to price that upcoming news in. Now, economic news, on the other hand, that's backward looking, because they're looking at things that have already occurred. For example, when there are 2 quarters in a row of negative growth in the GDP, technically we're in a recession, but that's not announced until 7 months later. So we're getting this news way after it's already occurred. So you may not want to rely on the economy to inform you of your investment decisions. And this is why market timing is really, really hard. Now, if it's hard for you to stick with your long-term investment goals listening to economic data, maybe you should just ignore it altogether. If you would like to see more financial videos like this, make sure you hit the subscribe button below. Thank you so much, and be wise with your money.